What does it mean to own stock in a company? Do you own a piece of that company? Are you just gambling that you think a company's value will go up or down? Some people have these questions about the stock market every day. Let's take a simple walk through what a stock is, what owning one means, and why someone would want to own a share of stock in a company. What is a stock? When a person owns stock in a company, the individual is called a shareholder and is eligible to claim part of the company's residual assets and earnings, should the company ever have to dissolve. A shareholder may also be referred to as a stockholder. For companies, issuing stock is a way to raise money to grow and invest in their business. For investors, stocks are a way to grow their money and outpace inflation over time. Stock investors earn money in two main ways. 1. If the price of a stock goes up during the time they own it, and they sell it for more than they paid for it. 2. Through dividends. Dividends are regular payments to shareholders. Not all stocks pay dividends, but those that do typically do so on a quarterly basis. There are two main types of stocks, common and preferred. Most investors own common stock in a public company. Common stock may pay dividends, but dividends are not guaranteed and the amount of the dividend is not fixed. Preferred stocks typically pay fixed dividends, so owners can count on a set amount of income from the stock each year. Owners of preferred stock also stand at the front of the line when it comes to the company's earnings. Excess cash distributed by dividend is paid to preferred shareholders first, and if the company goes bankrupt, preferred stock owners receive any liquidation of assets ahead of common stock owners. Let's go through some of the benefits of owning stock. 1. Claim on assets. A shareholder has a claim on assets of a company it has stock in. However, the claims on assets are relevant only when the company faces liquidation. In that event, all of the company's assets and liabilities are counted, and after all creditors are paid, the shareholders can claim what is left. This is the reason that equity, stocks, investments are considered higher risk than debt, credit, loans, and bonds, because creditors are paid before equity holders, and if there are no assets left after the debt is paid, the equity holders may receive nothing. 2. Stocks pay dividends. As we stated earlier, a dividend is a piece of the company's profit that it pays out to each shareholder every 3 months. An example of this is Exxon. Over the last 4 financial quarters, Exxon has paid out an average dividend of 87 cents. If you held 100 shares of Exxon stock for the last 12 months, that's $348 in dividends. 3. Limited liability. When a person owns shares of a company, the nature of ownership is limited. Should the company go bankrupt, shareholders are not personally liable for any loss. Can you make a lot of money from stock investing? Although it's possible to make money on the stock market in the short term, the real earning potential comes from the compound interest you earn on long-term holdings. As your assets increase in value, the total amount of money in your account grows, making room for even more capital gains. If you have any further questions, then make sure you leave a comment below. If you'd like more daily finance content, then make sure you hit that subscribe button to join our community of aspiring entrepreneurs and investors.